Hey traders, welcome to another episode of Charts and Coffee. Happy Tuesday, everybody. Hope everyone's doing well. Great to see you all. All right, so what do we have going on here today? Let's jump into the calendar here real quick. Yesterday around 2:20, we had a Powell event. It's kind of a sneaky one, odd time. And then today, we take a look at the calendar. We've got kind of a open calendar, not a whole heck of a lot going on except for FOMC member daily. Heads up for that right in the middle of the lunchtime doldrums. Got some factory orders. Normally, I wouldn't care much about trade balance numbers or factory orders, but devoid of anything much more impactful, they will take on a little bit more importance. So keep that in mind. Make sure you're always checking the economic calendar. And here's what I would also mention. Check the trading economics economic calendar as well, because if there are any other Fed speaking events, usually you're going to see them listed here. So Fed Evans at 9:30. That wasn't, if you noticed, it was not on the calendar. So on Forex Factory. So I'll check them both. I tend to like the Forex Factory calendar a little bit better, but if you have to choose one and you need to be aware of when these Fed events are going to occur, you're probably going to be better off taking a look at trading economics, because here you go, Rosengren, Meester, and then Evans. So keep an eye on that. Yes, it's kind of confusing. It's a little bit of a pain in the neck in terms of having to track two different calendars, but trading economics is definitely one that I would definitely keep an eye on, especially for those FOMC events. And if you're trading currencies in other countries, for example, in Sector Secrets Mastery right now, we're long Canadian dollar via Canada in many ways. We're long Canadian dollar in the futures room. We're long Canada via EWC in Sector Secrets Mastery. So, I need to be aware of any BOC events. I need to be aware of Canadian data releases. So if you're playing other countries, like I am, we're looking also at Germany, the Euro. So we're playing DAX and we're playing the FXE. So be aware that if you're playing things outside the US in that regard, that global economic calendar is going to be really, really important. All right, so let's see what kind of mood this market is in. Let's jump on over to the charts and take a look at what we've got. So first question is, happy Star Wars Day. I love Star Wars. I do. May the 4th be with you. You as well. The market looks like it's going to need it, maybe, at least the bulls. Can I please share my thoughts on XLE, XOM, and KMI at these levels? So if I take a look at XLE, and by the way, today we're rocking some TradeStation charts. Okay, we've been doing a little bit of TOS, doing a lot of TradingView, both of which I love. Today we're going to rock some TradeStation charts. And so if I look at XLE, and you mentioned at these levels, so Grogu, all my cards on the table, we're already long XLE and MPC and SLB in Sector Secrets, and we're scaling out. Yesterday, we were scaling out of, a number of our trades on that move higher, which brings me to a really important point when we see the way the NASDAQ is moving today. Take profits when you can, while you can, not when you have to. So we scaled out of a bunch of things. XLE and XOM are actually the same conversation. So if you have exposure to XLE, you have XOM, because XOM and CVX are the number 1 and 2 weighted stocks within the XLE ETF. Kinder Morgan, KMI, becomes much more interesting because in terms of overall outperformance, this thing's been en fuego. Buy the dips? Heck yeah. And it's a sub $20 stock. So that means 20 is going to be an interesting level as we move higher. But I love the idea of buying dips. But again, not today, my friend. If we were talking, so let me give you an idea. If we were talking on the 20th of April, most especially the 22nd of April, I would say, yes, that's a pullback correction to my wave and definitely double green environment plus wave equals ding, 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 buy, buy, buy. That's what I'm going to look. It's just really that simple for me. If I'm a trend follower and the market pulls back down to the wave and I'm not inside of an earnings window, that's probably the asterisk there. You don't want to be inside, say, 2 weeks to earnings, but it's a buy. Yeah. In that scenario, not at current levels, my friend. Okay, next up, how deep of a dive would I not consider buying the dip after a stock retraces into the wave? Additionally, how do I scale in during a pullback buy? I'm looking at TQQQ right now. Okay, so, what's sort of buried in that question, Line Watcher, and I can appreciate it, is how do you know the difference between a retracement of a trend and a reversal? Here's the newsflash, gang. We don't. There's always going to be that one last trend trade. There's always going to be that one last trend trade where we won't have the market as resilient and bounce back out of the wave. It'll stop surfing the wave. There's a reason I called it the wave, right? It'll stop surfing it. So this is the Ultra Pro. Look, if you're playing this to the downside or to the upside or however you're playing this right now, would I be long TQQQ? So it's the same conversation that I would have directionally. And this was the free video last night where I gave you guys just the zone, the levels, and the strike for the calls and the expiry that I'd be open to trading the NASDAQ in. Why the QQQs? Coming from a futures trader, I'll play the QQQs. I'll play the NASDAQ futures as well. Remember, this is a $17,000 initial margin requirement. Not exactly everyone's cup of tea. So what we're doing is we're taking advantage of the bearish momentum through the 21, clearly, down into the wave, which I love. So now, or if you don't know, now, however you want to play that idea, QQQ, TQQQ, maybe you're looking at some of the heavily weighted ETFs, the sectors within the NASDAQ, XLK, XLC, XLY, in their own respective trends. However you want to play this, to me, this is still a pullback buy, and I've got to trust that it will be a pullback buy until it's not anymore. Nobody knows where the trend ends, which is why, in the wise words of Charles Dow, we always presume that a healthy trend will continue. That's it. So, that's the bottom line. Am I going to look for pullback buys? Yeah, I'm going to follow exactly what I was talking about in the free video last night. I laid out the entire plan in the free video. As far as Bitcoin, Glenn, I'm still willing to buy pullbacks in Bitcoin. It's a trade. Bitcoin micro futures are coming. And I bring up Riot and Mara because, these are also good proxies for that. But right now, I'm not doing a lot with Bitcoin. Last weekend, that pullback was a heck of a pullback. And I did trade Bitcoin into that pullback. But I'm not holding. I'm not hodling. I've got family members starting to ask me about Bitcoin now. That's usually pretty much where I know that it's frothy enough to wait for a decent pullback. We got that last weekend, if you take a look at a daily chart of Bitcoin. So right now, probably not. But keep an eye on Riot and Mara. Can I comment on lumber and how rates can cause a pullback? So, David, lumber's gone parabolic, and the only way I'm looking to play lumber right now is what we're doing in the sector secrets, which is where we're long the Canadian dollar. So, Canada, EWC, really nice trend. Lumber is actually a pretty thin contract, not right now. It's what everyone's talking about, but that's a parabolic market, and I'm not going to engage in lumber right now. So, how could rates cause a pullback? Well, I don't think that's even a scenario that is realistic currently with any kind of proximity. But before rates go higher, there's going to be a taper. And we've seen taper tantrums in the past. So we will see a pullback in equities, but I would not right now consider that something that's going to give you a setup. But anything that starts to increase rates is going to eventually. It's the first domino to fall to start to decrease inflation, and that could then start to unwind the reflation trade. So, that's the way that would play out, but I don't think we're anywhere near that at the moment. All right, is this all about the dollar? Well, when you say this, you mean the pullback in equities? No, no. Oh gosh, no. In fact, the dollar's in chop. The dollar should continue to head lower. We've got a short dollar position via euro, via Canadian dollar. I'm looking to build it via Australian dollar as well. These were things that we discussed in the premium video for futures members. We kick that video off with a discussion of currencies. So the move higher in the dollar index futures is going to likely give us that pullback that we're looking for, or at least give us some proximity to it. But I'm not a dollar bull. And no, I would not consider the reason for the choppiness we're seeing in equities to be dollar related. No, not at all. Gang, we're going into summer. Yesterday I was going back and forth on Slack, and we were kind of joking about how odd the markets are. And finally, we both kind of laughed. I was going back and forth with one of our VIP moderators in Sector Secrets and the Futures Room. And Lauren and I were going back and forth. And I said, this is normal, gang. This is a normal market. If you just started trading recently, maybe in 2020, that was abnormal. That's not normal. Don't expect that. What you're dealing with right now is what most traders who have been trading for 10, 20, 30 plus years know. This is a normal market, gang. This market in 2021 is normal. Don't think 2020 was normal. It wasn't in any form or fashion normal. Normal is not parabolic uptrends that continue for 4 months, where you see short squeezes on everything. Normal is not when penny stocks just go sky high, because that's just what they do. That's just not normal. I think for a lot of traders, acclimating to this year is really acclimating to what most of any trader's trading career is going to look and feel like. Markets just don't go straight up like they did last year. So, looking for a reason, gang, this is normal. You don't have to look for a reason as to why what's happening is happening. Again, this is sort of what markets typically do. You can look at volume to understand the participation behind it. We are going into May. I do not subscribe to sell in May and go away, but we do know the doldrums of summer are mostly concentrated in July and August of most years. But I think the summer is about as active as you're going to find lesser active normal months, right? So sell in May and go away is definitely not something I subscribe to. We'll see what's really happening is the battle between what bonds are saying about inflation and the denial that the Fed has about inflation. If there's anything that's persisting in concerning the market, it's that chasm between the words of the Fed and what bond traders are saying. And bond traders against the Fed, in the near term, bond traders can be wrong for quite some time. History always looks back and says, you see what bonds did 8 months ago? But in that 8 months, the Fed has really got more control over the market than, say, bonds do. Bonds reflecting what the equity markets are going to do is best seen in hindsight, because again, they can be wrong for a really long time. So, go back and look at that synchronicity. It's not immediate. It's not immediate. The market can continue to make new highs despite what bonds think about the Fed's opinion of inflation. All right, MTB. Michael, not a double green. I'm not crazy about looking at this. What I would say is, if you're looking at banks, crack open KRE, crack open XLF, and find maybe some relative outperformers. This could rise with the tide, depending upon its weight. This might be a KRE name, right? So I would look to see if there's anything with better structure, preferably double green within KRE or XLF. I love financials right now, though. I will tell you, index level earnings growth. I was reading something about that yesterday. Index level earnings growth is typically led by financials. So I love where your head's at. Okay, so next up is, hang on, Gavin, get down to these questions. RTY. So the Russell is or the IWM, whichever flavor you choose of the Russell. This is not an index that is in an overall uptrend like the Dow, which is my absolute favorite in this environment. Remember, gang, in a reflationary environment, the Dow is going to benefit disproportionately. There's no question about the steadiness and the structure, bullish structure of the Dow being the best amongst the major three. And you get to the fourth, and I don't consider the Russell a major index. No offense to the Russell, but I just don't consider it one of the major three. And it is more disconnected from those three. So you've got the S&P, NASDAQ, and the Dow on one hand, and then you've got the Russell way over here. And the reason for that is the weighting and the composition of the Russell is its own universe. It's not a high concentrated weighted index, and its structure in terms of even the sectors are not high concentration weighted. And even the composition down to the individual stocks, the S&P, the NASDAQ, and the Dow share much more in common than it does with the Russell. I don't believe either that the Russell is a leading indicator. I think a lot of people think, well, where the Russell goes, the broader markets go. There's a lot of other factors, gang. So don't get trapped into that either. So be careful with the Russell. I think a pullback buy around 2255, 2250 is buyable, but it's not a trend following pullback. So be aware of that. I think the KRE would be a better place to think about if you want a Russell-esque type position. I actually look at KRE in lieu of, say, IWM or Russell. All right. I don't know if I've ever seen sector rotation like we've seen this year. Yeah, this is, again, gang, it's pretty normal. I think if everyone here can give them, and it's going to depend on your experience within the market. I know a lot of you have been trading and investing for as long as I have. So for those of you that have been in the markets for 30 plus years, you've seen 3 decades of craziness. You're gonna realize that my first nutty market was when long-term capital management imploded. This was the Russian narrative. All within about 18 months, we saw Asian contagion, that ruble Russian crisis, and long-term capital management imploding. If you traded through that, say 96, 97 into 98, every single crisis, just the scale has been different, but the feel of it and the reason for it are pretty much the same. Over leverage, long-term capital management. And you should read the book, everyone. If you want a good, quick, really fun read, read When Genius Failed, because it is the model for every single crisis we've had. And they've all been crisis of leverage. When you get right down to, what was the reason for the implosion? Leverage. So, in terms of the rotation and the volatility, yeah, I mean, this isn't really that crazy. I mean, it's hard to look. Let's step back and look at the forest for the trees, gang. If I look at the overall trend in this market, it's overall heading higher. It's just the path that it's taking is a lot more volatile. And I think the NAS is one of the more volatile markets. And that would also reflect that if your experience of the markets right now is focused on the NAS, it's a very different experience. If your focus is more IYT, XLI, YM futures, again, very different experience of the market. So, I think it's easy to talk too much about FANG and tech. And I get that, in terms of sectors, it's the most impactful. But your experience of the market is going to be dictated in many ways by your experience, period. When you look back and refer to market scenarios and action that you've experienced in the past, but also which markets are you focused on? Dow has been great. I wish Dow would pull back the way the NASDAQ has been. So think about getting much more granular about the sectors that you're looking at and much more granular about the individual stocks you're looking at. And I think this market's going to make a whole lot more sense. And I hate to be a skipping record. This is not last year's market, gang. Last year wasn't. It was a different kind of market altogether. So if last year is sort of the way in which it's your touchstone for normal, your best bet is to get amnesia about 2020 and look at 2021 and say, okay, this is where I cut my teeth as a trader. This is where I learned that not everything goes parabolic for 4 months. That's really and I think what you're also going to find, how do you remedy that? And I'm going to wrap it up with this thought. You remedy that by what we did in Sector Secrets yesterday. Yesterday, we hit initial targets, in 4 of our stocks in our books. So we were pretty active taking profits, not really active building positions. And what you're going to find is those really ambitious first targets that worked in 2020, out of the money calls that worked in 2020 because the market was parabolic in so many corners. You're going to have to be a lot more prudent about those first targets. And then you're going to get more ambitious about the second target. For example, in XLF, which is one of our Sector Secret trades, first target was really prudent. It was pretty close. It was within the confines of previous highs. Second target, now we're really going for it. The second target, it's really like having, I love using baseball analogies because that's what I've always used when it comes to position management and position size. This is the count in your favor. This is the count in your favor. This is an 0-3 count, right? You can take a couple shots because the pitcher is sort of who's going to have to throw their way out of the problem. So the way I look at it right now is when you've got a trend and you've hit the first target, remember, now you have the advantage. You can control your own adventure. You can choose your own adventure in a much more ambitious way. All right. So I would say in this environment, make sure your first targets aren't out in the stratosphere. It's going to hurt you. Okay. All right. So I'm going to wrap it up with that thought. Thank you as always for being a part of our Charts and Coffee crew. I definitely, again, I feel everyone when they're saying, hey, this is difficult. Just recalibrate to what normal is. Don't have the expectations of last year. And I'm telling y'all, you will be fine. Watch this building is going to be extremely important. What you trade is going to be far more important than how you trade it. Start looking in different corners of the market. I'll see you tomorrow. Same time, same station. Be good to each other, gang.